Welcome to the Dakota Live podcast. I am your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, sales leaders, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out Dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or a recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Cocktails. Are you looking to expand your network and connect with other professionals in the investment industry? Look no further than Dakota Cocktails, the premier networking event series for sales professionals, allocators, and more. Our ongoing series of events takes place in cities across the country, providing you with the opportunity to connect with like-minded individuals and build meaningful relationships. At Dakota Cocktails, you'll enjoy delicious drinks, great conversation, and the chance to connect with industry leaders. Whether you're looking to make new contacts, explore potential partnerships, or simply learn from others in the industry, our events are the perfect place to do it. Join us at Dakota Cocktails and discover the power of meaningful connections. Visit our website at dakota.com/cocktails to learn more and find an event near you. Well, I'm always happy to introduce my partner on the desk, Andrew O'Shea. How are you doing, Andrew?
Doing well. Happy to be here. Excited to hear from Doug.
Yeah, me too. I'm glad you're here. I'm glad Doug is here as well. He's remoting in from Los Angeles, where apparently it's a brisk 70 degrees. And he's struggling. He's struggling through the 70s right now, but we wish him the best.
Yes, we do.
Doug, welcome to the show.
Thank you, guys. It's good to be here.
Well, I'm really excited to introduce you to our audience. If people don't know you, Doug MacBean, Senior Managing Director of Investments at the California Institute of Technology, CalTech. Doug, thanks so much. We are really excited to ask you a bunch of questions about your role and your experiences as it relates to your work with CalTech. But before you do, I am going to read your biography for the audience. Well, Doug is the Senior Managing Director for Investments at CalTech, where he's been part of the investment team for nearly 9 years. In his role, Doug is responsible for a variety of functions, including, but of course not limited to, manager research, oversight, asset allocation, with his investment staff colleagues. As of last summer, Doug began overseeing the investment team. Doug began his investment career in 1999 in equity research for Robertson Stephens and subsequently Jefferies, until joining Stanford Management Company in 2007, where he spent nearly 5 years covering public equities. Doug came down to the greater Los Angeles area in 2013, and after a brief stint at Nazarian Enterprises, Doug joined CalTech in their offices on campus in Pasadena. Doug graduated from Harvard University with a degree in government, where he was a member of the golf team. He also earned his MBA from UCLA's Anderson School of Management. Doug is originally from the Philadelphia area, but calls Los Angeles home, where he lives with his husband, Ronnie. Doug, thanks for joining us, and congratulations on all your success.
Yeah, thank you again. I'm looking forward to our conversation.
Yeah, we are as well. I always hate starting these podcasts off with bad news, but Harvard's golf team lost their spring opener to UCLA. Mixed emotions there, or are you following it anymore?
Well, somehow that's gotten lost in all the news of the last few weeks, at least getting to me. As I didn't actually play during my graduate days, so I guess I'm more loyal to the Harvard team. So yes, that's devastating news, although not terribly surprising.
Yeah. And do people in California golf when it's 70 degrees, or do you have to wait until it gets back into the 80s?
Well, to be clear, it's not 70 degrees today. It's raining and 50 something. That's why I look like I'm all bundled up. Yes, that was growing up in Philly and being a golf player, right? You play in pretty much any conditions that are thrown your way. You need to. Because you got to practice all year round. So you got to take whatever comes your way.
It sounds like you're talking about the markets again. So I was going to ask you what lessons you took from those days, playing golf, whether it's in your high school years or your college years, and how you think about that. But you partly alluded to it. But As an athlete, there are a lot of athletes in our industry, former athletes, either in college or even professional. What were some of those lessons that you took from the course, and what do you see there now?
Yeah, I mean, golf there are a lot of analogies. The most obvious one is patience. Golf is definitely a game of patience, just like investing. I'd say like investing, just practice is pretty. Just each day of investing, each day being involved with the markets is one more day of knowledge and one more day of wisdom that you can take with you as you invest today and tomorrow. I think there's also a lot to be said in golf for you just have to know thyself, know what you're good at, know what you're not good at. I'd say that's also really important in investing. You can get yourself into a lot of trouble if you start dabbling in asset classes or investments where, if you're really being honest with yourself, you don't know what you're doing. That's something to avoid at all costs. Similarly in golf, you could be presented with a shot where, oh no, you've got this, Doug. You've definitely got this shot. And the reality is you don't have that in your bag. It never did. And you really should be looking for something a little more, down the fairway and a little safer. So I think there's a lot of analogies, a lot of parallels to take from my experiences in golf.
I think that's interesting. One of the things you did say is, is trying to become an expert in something. Sometimes, your asset managers, my own experience as an asset manager or working for asset managers is that when things do happen, crises happen, you try to become, and the firm tries to become an expert in it very quickly. And then they try to kind of pass on that expertise or what they've learned in the last few days or the last few weeks. How do you discern that? From those folks who actually, work, let's say in the banking system, maybe they're a hedge fund that focuses on financials versus a global equity manager who had some financial exposure and is trying to kind of figure out, I guess you could say, kind of another analogy, ride the bike while building it. Yeah.
I mean, one is always a healthy amount of humility in moments like that to just, again, know thyself and know that the reality is you're not really an expert. You're not really the expert in anything. There's always somebody who knows a space or a company or an asset class better than you. The second then is with knowing that is to reach out to those whom you know and who you know to be more expert in these particular areas. You mentioned the banking sector. And so if over the last couple of weeks, if we had questions with regard to what's going on with the regional banks, some of the more structured products within them. We have investment partners who have much deeper expertise on that. Let's go talk to them. And let's make sure we can inform ourselves, educate ourselves by going to the people that we trust and we know to be of much greater knowledge in these particular areas than ourselves.
Well, you started your career in equity research. What were those first few years like for you, in terms of, sitting at the desk, going through, I'm not sure if you had a specific sector or geographic coverage, but, perhaps in the context of what you're doing today relative to how you started your career, how have you seen that bridge divide?
Sure. I started in the late 90s in San Francisco and in the tech space. So it was a great introduction to business coming out of college. That was just a really fun time. It was .com 1.0. San Francisco was the place to be. There was venture money flooding in everywhere. It was just personally a very, very fun introduction into the business world. It also disappeared in 12 to 18 months from my arrival in 99. So a lot of lessons to take from it. From the investing standpoint, I focused on what was called at the time e-services companies, which really would just be consulting firms. So if you can remember in the late 90s, that was when, a Bank of America just needed to have a website where you could log on and check your balance. That was like earth-shattering technology 25 years ago. And so all these consulting firms popped up out of nowhere and were providing really just basic web services or the building blocks to develop those for companies. And these companies grew, monstrously for several years. And they got swept up as well in the tech boom. And then when the tech bust occurred, I think 3/4 of my coverage list disappeared in 9 months. And that's not an exaggeration. They were all, people-based businesses. The moment the economy turned, the demand goes away. You just have to fire everybody, and pretty soon we were just transition our coverage list over to EDS and Perot Systems and the Indian offshore companies. These sort of Accentures, boring, stable, much more large cap. So that was an interesting experience to go through the boom and bust. I think that one thing I've always taken with me from my equity research days, obviously an analytical rigor to getting to know a company, hopefully better than anybody else. And then finally was the ability to communicate, both written and verbal. I actually, whenever I'm asked by someone new to the industry or more junior, I always say the ability to write is a skill that is incredibly important to what we do, to be able to convey an idea, both written and orally. And I just see increasingly fewer and fewer people, younger people, with the ability, I think, to write effectively. And I think that will differentiate you that much more. But it was critical, right, as a research analyst, because you're writing your research notes were your work product, were your way of conveying your ideas.
Yeah, that makes sense. I grew up in equity research as well. I was at Greenwich Associates at that same time. So 1999, 2000, and we had programs called e-commerce. And then 2 years later, we did not have e-commerce. So I completely understand that situation. But it's interesting because during that time too, in a traditional analyst program, you're taught the fundamentals. You're taught how to write an email. You're taught how to answer the phone, how to leave a voice message. Yeah, I couldn't agree more. I think those are skills that are a little bit lost.
It's right. It sounds so silly, right? The ability to leave a voicemail, like as if you need to be trained. But the reality is, I do find that increasingly, I guess, especially younger people really struggle with the ability to convey themselves and convey ideas. And it will always be critical. It will always be essential in the world of investing.
Yeah, just a quick funny story. I remember I was working there and we had very senior consultants. So it was basically a bunch of 20-nothings and then a bunch of people in their 60s. And I had never left an answering machine voicemail. So, hi, this is Robert Morier. So I left this message that said, hi, this is Robert Morier with Greenwich Associates. I'm either on the phone or out of the office. Please leave your name and number. And one of these consultants called me screaming, saying, well, where are you? Are you in the office? Are you out of the office? Where, I don't know where you are. So it's just these little basic nuances of kind of professionalism that I was happy to get them. It sounds like you got them as well, Doug. So
yes, I 100% agree.
Well, you moved to Stanford Management Company at also an incredibly interesting time. You were there in 2007. You worked under the late John Powers, who accomplished some pretty incredible things coming out of that crisis. So, can you take us back to those days? What were you coming into in that role? You were moving into the allocator seat for the first time, and what did you learn through those years working with John, and then just kind of working, in the endowment model?
Yeah, I mean, the transition from the sell side to an allocator seat was exciting for me. I after 6 or 7 years of being an expert on 20 companies, right, of deep DCFs and knowing Accenture better than anyone, or hoping I did, it was apparent to me that something was missing in terms of what I was looking for out of my career, and intellectually it just wasn't offering me the same reward that it had when I started my career. And so in talking with a variety of people, I got some good advice, and some people who knew me well said, Doug, you're more of a bigger picture, 30,000 foot view kind of thinker than a 3 foot kind of thinker. And I that really made a lot of sense to me. I enjoyed maybe going back to the golf thing, I enjoy something that's kind of taking the long game, and it requires patience and more of a mosaic kind of approach. I mean, and so when I was introduced to the idea of, I always knew there were endowments, but I really didn't know what the endowment model was. And I was fortunate enough to be reintroduced to John Powers. He happened to be the head of research at Robertson Stephens, where I was several years earlier. And since then, as you pointed out, he had taken over CIO role at Stanford Managemet. I had a coffee with him in New York in June of 2007. I remember it well. He walked me through what Stanford did, the endowment did, and said there was a position open in the equities and hedge funds team. Would I be interested in moving back to the Bay Area? And I tell you, Rob, the whole thing just was so exciting to me. I was like, wait, there's a way to work in this field and support an institution like Stanford and have an investment time horizon of infinite and invest in every asset class in the world. I was like, this is too good to be true. Pinch me. And so I doggedly pursued that opportunity it took about a half a year, several trips to the West Coast again. And I was fortunate enough to get that role in November of 2007. You pointed out, I did jump into the role at a very interesting time. I feel fortunate that I was housed safely within an endowment during the GFC. I mean, if Stanford was going away, then there were much bigger problems in the world, and so I was fortunate to be housed in that environment. And yeah, I focused on domestic equities and hedge funds primarily during my time there. There's what is applicable to my prior role was that I'd served in the seat of an analyst, of a research analyst, of someone who did the rigorous, detailed work on companies. Now I was in the seat to evaluate those firms and those individuals. And so that was one of the bigger transitions, and one of the skill sets I was able to apply is I didn't have to do DCFs anymore, but I could sit across the table from an experienced research team and have them show me one of their DCFs and be able to walk through it and be able to ask informed questions to understand and evaluate, in my view, whether or not these men or women knew what they were talking about, if I thought they were focused on the right things, et cetera.
Interesting. Well, people like John Powers and David Swenson at Yale really became these luminaries in the endowment world, and they created these models that have since been carried forward and applied to several different institutions. So as you think about the Stanford model relative to what CalTech is today, so maybe two questions is like, if you could elaborate, what did that model look like in terms of what was being presented when you started, what John built, and then for people who are less familiar with CalTech, could you talk a little bit about the model that CalTech employs, and just some kind of some of the blocking and tackling of assets under management in the team? Sure.
Yeah. So you can imagine Stanford, and Stanford is an enormous institution, right? And a storied institution, housed right in the heart of Silicon Valley. So there's definitely a mantra and a mindset on that campus, and certainly within the investment office, and also just because of the various constituencies of alumni who are luminaries in the tech world and are obviously probably very generous donors. Like there's just a very growth, risk-on kind of mindset, I think, that permeates just that whole geography, not just Stanford, but the entire Bay Area. And so I'd say one difference between Stanford and CalTech is certainly a growth-oriented portfolio, but there was just a mindset in general at Stanford of growth, risk on, heavy allocation into venture, and certainly on the growthy side as well within the equities world. So, because one thing that's often lost when talking about the endowment model and in comparing endowments and how they invest is the side that you don't see, which is the liability side. Each university has different risk tolerances based on any number of factors. And those do often inform key differences in their asset allocations. I'd say just the overall mindset of the team, of the school president, how that informs the trustees, the investment committees. There's just a lot of various inputs that one wouldn't just optically see looking at what is the asset allocation of a Stanford versus a CalTech versus a Yale. So that was one thing I would say. Specific to John Powers, what I think he did best and what I appreciate his leadership for most was during the teeth of the crisis, he was remarkably calm. As I reflect upon it now, I was still fairly young. I was maybe 30, 31 going through that. He just had a tremendous sense of calm that this would pass, that we would survive this. No, not just each individually. The endowment would survive. Stanford would survive. The world would survive this. And I think that level of calm in the teeth of something really unprecedented and profound, actually, is for those of us who went through it. That level of calm was incredibly important as an investment program to have your leadership provide that day to day. Because, there were, I remember going to New York in January of 2009 for a work trip, looking down 8th Avenue at 8 p.m. one evening and not seeing a single soul. It was like out of a sci-fi movie. I mean, New York was desolate. Like it was a very scary time. I mean, for those of us who went through it, if you can recall the teeth of that. And John was just a total calm in all of that. And I always remember that most strongly about his leadership.
That's interesting. It was a tumultuous time. I was working for Goldman Sachs Asset Management, and not only were people not out on the street, but you also couldn't leave your desk. You weren't able to go between floors because there was so much crisis management going on. Wow. That they didn't want, to have to, basically create more interference in what was, as Doug had said, these really unprecedented times. So, thanks for sharing that. So now you're at CalTech. You've left Stanford. You've taken all of these lessons. It sounds like calm and fortitude were two of the bigger takeaways. But so you rightly said, the liability side, also governance, the way that you think about governance at CalTech. But what did you come in at CalTech, and how is CalTech structured today? Yeah,
so I joined CalTech in 2014, focused again as in a director role, overseeing the global equities portfolio. In addition to our fixed income investments, although when I joined in 2014, we didn't have any fixed income investments, so that made managing that side of the portfolio easy. So really just came into focus on a global equities portfolio. My role has since expanded during my tenure to oversee about half the hedge fund portfolio, and then, as you alluded to in the introduction, last summer I was promoted effectively to deputy CIO. And now my role is to oversee the investment program and the investment team. The CalTech, Stanford, a huge difference here too. Stanford was $22 billion when I joined. CalTech was $4 billion when I joined. Excuse me, it was $2 billion when I joined. We're now about $4 billion, which is, it's funny when I mention these numbers to my spouse, and I don't even sometimes say billion. I just say 4. We're going to invest 10 in this. And he's like, you mean million, right? And I was like, yeah, like these numbers, they start to, you start to forget the numbers. You forget the numbers you're talking about here. So CalTech is a $4 billion endowment now. What's interesting about CalTech, and not a lot of people know this, is it's only 900 undergrads total. So it's a very small school when it comes to the undergrad population. The graduate and postdoc population is actually about 1,200, I believe. So the school supports 2,100 students, but very different from a Stanford, in that Stanford had thousands of undergrads, in addition to having medical school, law school, business school, things like that. CalTech doesn't have any of those. It's a pure math and science oriented campus, which is quite special. I always joke that I don't understand 99% of what goes on campus, but I absolutely love that what I do supports it. And I mean that sincerely. That resonated with Stanford. That resonates at CalTech. I always feel so fortunate that I get to work in the investing field and have my efforts support the tremendous higher learning institutions of our country. I think I feel incredibly blessed that my career has led to this spot.
Doug, you have global equities obviously in your roots, but can you talk about the mix between privates and public equities now? What does that look like?
Yeah. So I'd say roughly at the endowment, about a third of our investments are in public markets. And there we're pure in our investing. We don't include, some of our peers include like long short equity in their public markets allocations. We do not. That's purely long only investments. I'd say another third is roughly in private markets. So there, I'd say roughly about 7% in venture capital, low 20s in buyout and growth. And then the remainder, a little bit in real assets, and real estate's another 4 or 5%, let's say. And then the remaining quarter of our portfolio is in what we broadly call alternative securities. The way I think about that is if it doesn't fall cleanly in bucket 1, public markets, and bucket 2, private, it falls into the third. So that's everything from your traditional hedge fund out, like long short equity, multi-strategy, event-driven type hedge funds, to really one-off things like a power-producing strategy in Latin America, to a consumer credit strategy in Argentina, to a life settlements oriented investment. It's kind of a catch-all.
That's helpful. I have a question because of your experience. You grew up on the sell side initially. You went to a large endowment. Obviously, the environment's changed in terms of some of the factors out there, like the growth of passive investing or the awareness of factors out there. Can you talk about what you think in today's world differentiates a public active equity manager?
Yeah, this is one of the great debates, right? That rages on still within our world. There's a handful of ways for an active equities manager to differentiate themselves, and it is difficult to do. Concentration is obviously one of the obvious ways to do it. Don't own the S&P 500 stocks. Compete with the S&P by owning your best 10 ideas. The challenge of that, of course, is tracking error and volatility. The good news is, as an endowment, I can stomach tracking error and volatility because my time horizon is forever. And oftentimes volatility is my friend. And to be clear, we don't actually talk very much about tracking error at the endowment, but I understand that other types of institutions or individuals have a very different risk profile than we do in that regard. I think there's I'm not anti-passive. I will say sort of what is sort of intellectually true, which is that the only way to guarantee you will underperform a benchmark is to invest passively. Because passive will get you the benchmark less the fee you're paying. And so you are assured of underperforming that benchmark. Now, I'm also very well read and versed in the research that shows that active managers over time have about a 0% chance of outperforming a benchmark. So you're kind of asking yourself, geez, what am I supposed to do here? And so what I think is key to our role is to meet a whole host of potential partners, get to know them over a long period of time, try to find that special skill, that special niche, something that about the individual or the team, something about the markets in which they invest, something about the way that they structure their portfolio, hopefully some combination of all of those. That's really what I think you're looking for as an allocator in a potential partner. And so I give you a couple of examples then in sort of ways that we think about investing. For example, we have a very concentrated life sciences portfolio. And the appeal of life sciences to an endowment, one is the time horizon for investment success in life sciences is many, many, many years. Just because the life cycle of drug discovery and drug companies is decades typically. And so, again, it's also a very tough space in which to index. It really calls for true medical and financial rigor and skill. And so that's just an area where we think if we can find the right partner, we think we can navigate what is a very precarious investing environment, trying to successfully pick life sciences companies and reap the rewards of being successful there. When it comes to sort of more, bread and butter, large cap growth, we still skew toward the active side because we think there are teams that can outperform over time. And we have a couple of those who, with 7-10-year track records, at least under the belt at CalTech, and much longer track records historically, have a proven ability to do that. But year in and year out, there's no way you're going to have every strategy beating the S&P. In fact, if you have every strategy in your portfolio beating the S&P, you have a serious risk problem. And so it is an expectation in any given year that at least one or more of our strategies should be underperforming if we're diversifying our portfolio correctly.
As you think about that, those active managers, whether they're concentrated or not, do you think about specialists versus generalists? So how granular will you get? Will you look at, Japanese long only versus a global equity mandate? Or, do you try to allow your managers or your asset management partners to go wherever their ideas take them?
Yeah, Rob, I mean, it's a good question in that what you're asking yourself as an allocator is, what is the role of this specific of team or of this mandate? And each, we have about 15 public equity strategies in the endowment today. Each one has a very specific function. And we obviously are mindful of how the 15 all interact with each other. That's another consideration for us. The beauty of investing for an endowment is that we can and do invest in anything, anywhere, globally. So to the examples you cited, absolutely, we could invest in a Japan long only. I've already cited a concentrated life sciences fund where the largest investment is 40% of capital. And we have a quant global EM mandate that provides us our basic global EM exposure, for which we pay, not very much fees. And we feel like a quantitative model can cover a global range of investments better than a fundamental team. So I know there are those in my industry who think that the only investments and investment firms worth looking at are 100% owned independently, all concentrated, 8 to 10 stocks, usually niche like a Japan only. And then the view is if I have 15 of those, I roll them all up. I have a global portfolio of 100 to 150 stocks, all being managed though by specialists. I completely understand that perspective and peers of ours who do that. That makes sense to me as a portfolio construction. At CalTech, we take a little bit of a different tact, and we're not quite so dogmatic about only that archetype can work for us. I think we're a bit more open to, there's a time and a place or potential need in your portfolio for a whole host of strategies.
Yeah, that construction process that you described is not a cheap one either. So if you think about fees and governance, it's certainly something that we're attuned to. That fees have been going down in the industry over the last decade. So it sounds like a very pragmatic approach. I appreciate that. As you kind of take a step back, you alluded to asset allocation a few times, but what does that process look like? Are you actively allocating across asset classes, or are you relatively static and you revisit it once a year? What does that process look like from a top-down perspective? Yeah,
so we work closely with our investment committee, who's involved in our asset allocation framework. We don't revisit that on a yearly basis. It's usually set over mid and long-term targets. So I would say the midterm, is 3 to 5 years. The target does change a little bit, typically between each time we revisit every handful of years. But generally, it tends to remain fairly static. It's constructed in a way to optimize achieving what is our ultimate investment objective, which in most cases for an endowment is whatever your payout is on a yearly basis to the school, plus inflation, plus hopefully a little bit of growth so that the asset base itself does grow over time. That in a lower inflation environment, or hopefully a normalized inflation environment, let's call the payout 5%, inflation's 2%, a little bit of growth, another 1%. Your bogey is somewhere in the high single digit year in and year out on a risk-adjusted basis. I think our 10-year number when I last looked at the print was something like 9 or high 8s or something. So, we're right there. But you don't want to move around the frameworks very much in terms of your asset allocation targets, right? Those are things that are your guideposts. You don't want to be whipsawing that around and changing it conveniently because of the team's whims in a given day. You want that to be something that's quite steady and is guiding you into the future.
Yeah, Doug, if you could elaborate on your sourcing process, particularly on the private market side where you have over 2/3 of your exposure. What does that look like from initially sourcing to the due diligence process to ultimately an allocation?
Yeah, it's a good question. One I get asked a lot. There isn't really a tried and true format to it. A lot of it is conversation, is referrals, is there's a little bit of just cold calling or cold emailing and introducing a fund to us. What I alluded to earlier and is let me take a step back. Again, our investment horizon is infinite. We don't actively manage, investments on a day-to-day basis. I'm not there looking at a Bloomberg on a day-to-day basis, seeing what's blinking green and what's blinking red. That's just not what we do. And so a lot of what we do, therefore, is having conversations, is talking to current partners, potential partners, peers, anyone in that mosaic of the investment landscape, I think is a lot of what our job is about. And so when it comes to potential investment partners, I think we're fairly open to introductory meetings with I don't want to say just about anyone, but with individuals with an interesting pedigree who might be going out and launching their own thing. Obviously, established institutional funds. Certainly, anyone CalTech alum, anyone with an affiliation to CalTech. We always want to be mindful of being good, being good members of the community and engaging with CalTech alum. But I think it's incumbent upon us to cast a very wide net and at least have initial conversations with a very, very broad group of potential investments, because quite frankly, you just never know when a particular individual or a particular conversation or particular opportunity set just piques your interest. And it isn't like then you just hand over the check at that meeting. But what it does do is it does begin to say, hey, that was an interesting individual. That was an interesting conversation. The next time he or she is back in LA, or the next time that I happen to be in their hometown, maybe I'll stop in again and we'll further that conversation, or I'll take the opportunity to get to know him or her a little bit better. And so I can't provide you here's the roadmap to what we do, but I can tell you that it is kind of just an ongoing narrative of individuals and teams and strategies where we are, taking inbound as well as we travel a fair. My colleagues and I do travel a fair bit. That's partly too just to get us out of the tiny Pasadena mindset, and it's always interesting to hear what people are talking about in London or Hong Kong. It's never the same perspective as you're hearing generally in LA, and so. That's a lot of the initial. I'd say when it comes to how do you narrow that focus, that is a lot of, I'd say, the judgment of myself and my colleagues. One, there's obviously the consideration of what are the needs of the endowment at this moment. For example, we might have a view as a team that Japan is particularly interesting for XYZ reasons. If that's the case, then it's incumbent upon us to start prioritizing talking to Japan-oriented funds or Japan-focused funds, and to either then do outreach to those whom we already are in dialogue with, open ourselves up to potential inbound. So I don't know. I always just say it's just an ongoing conversation, ongoing narrative of engaging with. I think in any given year, we engage with hundreds of investment firms, even though we only have about 60 to 70 active partners.
How about those active partners? So as an LP to some of those GPs, we were talking about 1999 and 2021, very similar VC markets. Lots of capital, lots of dry powder. I'm assuming a lot of the LPs in 99 were getting the same calls that they were getting, or you were getting in 2021. So now coming into 23 after a very difficult 22, how do you see that relationship with your GPs in terms of, the sourcing of the next vintage or, the next great idea, particularly with the amount of capital, that they've kind of taken on over the last couple of years?
Well, you said it, Rob, they still are sitting on a lot of dry powder and a lot of capital. And so particularly in the venture world, and I haven't been close enough since the Silicon Valley Bank to know to what implications that had in sort of shaking things up, but I'm guessing it has a decent amount in that world. The conversations, frankly, they're still fairly well funded. Most of them have probably raised fairly recently. And so in terms of any sort of stress to their model, I don't think you're going to see it for a while. I think the question mark looming over the venture space certainly is just valuations and their existing portfolios and what is the true value of what they own. I think that's an interesting question. You certainly have the disconnect of the public markets and certainly the tech side of the public markets falling out of bed, while you still have venture-oriented venture funds, crypto funds holding their funds at cost. There's just a disconnect there, and we'll see how that all shakes out. I'm a believer that gravity still exists, and that the public markets are telling you something. The private markets eventually find their way to learning the same lesson. But time will tell. The conversations fundraising is still ongoing. I haven't seen it. I haven't seen a market slowdown. I think the pace of calls has definitely slowed down as markets have become more volatile. So I guess that's something I would note, that just in the last few months, I do think the pace of calls has slowed. But the appetite for venture, Rob, you can appreciate venture has been the place to be for the last 10 years. And people have a hard time unlearning that, what's worked for 10 years, the past 10 is probably not what's going to work over the next 10 as well. I don't know. That's something I would argue.
It's a good point. I would agree. I think it's a little bit of going back to basics, so you're, getting to know, the companies that you're investing in. You're absolutely right about the valuations. But the luxury that venture and private markets have is they've got the time horizon to figure out what the valuation is. Whereas public markets don't have that same luxury. So I agree. I don't think too much will change, but I think enough will change in terms of kind of the fundamentals of due diligence and trying to figure out the people behind the ideas and what the opportunities are. But those are great points.
There will always be, great ideas, great new companies to be founded. I'm not knocking venture capital writ large. I'm knocking the mindset that it's the only game in town. And that because when I look back at my, when I look at our track record sheet, when I look at all of our funds and say, well, look at the venture returns, as we know in every disclaimer on a public markets, literature, past performance, right, is not indicative of future returns. And so that's a challenge for any investor, is to not get set in the mindset of, well, what worked last year? That's what's going to work this year. Is you have to remain open and curious about, and maybe even a little skeptical, as if something's worked a little too well for a little too long. Maybe that's not the best. Maybe that's not the best use for the incremental dollar over the next 10 years.
Could you talk about emerging managers? That those words mean different things to different people, but you mentioned finding interesting backgrounds and portfolio managers that might be leaving and starting their own firm. How do you all think about underwriting emerging managers? Do you allocate quite early to emerging managers, or is it more, let's see how the firm grows over the next few years and revisit?
Yeah, it's a little bit of yes to all of those. There's nothing in what we do that says we can't be a day one investor. We have invested in what emerging managers as you just described them. It can be, again, a pedigree that's of interest. Can be a particular niche. Sometimes the size is appealing to us. I mean, one of the advantages, Seth Alexander, who oversees the MIT endowment, who I think is kind of brilliant. And the way he approaches investing, I think, is very straightforward. He always says, take advantages of what your institution's advantages are. And you just know what they are and take advantage of them. Well, at CalTech, I'm not Stanford. I'm not 40 billion. I'm only 4. But at 4, a $10 million investment can really move the needle for me. And so an emerging manager coming out in the venture space and wanting to raise 50 million, well, my $10 million check is material to them. It's material to me, but Stanford would never write that check because it doesn't move the needle for them. And so, yeah, we're definitely open to talking to and getting in front of individuals early. It's very possible that it might be too early for us, or more likely that the fit or the need within the portfolio doesn't exist. But we certainly want to get that dialogue going, because I always joke that the goal with what we do is a long courtship for a longer marriage. And we might not be set up, or we might want to watch and see a little bit how fund one goes for you. But what's important is that we start the clock at fund one, so that by the time fund two rolls around, we're not in day one getting to know you, we're in year three. I think that's, and I think the investors who get it are those who know that a conversation with a Doug at CalTech, the first conversation isn't just going to be the one where the check comes, across the table, and not going to be the second meeting either. But no, there are times where individuals, after a second meeting, more or less say to you, like, "So what are we doing here?" And I'm like, "We're having a conversation. We're getting to know each other." And Rob, I mean, you know this, Rob. You appreciate, right? Yeah, your background, right? Like, because there's also so many other elements to this. I talk to so many peers. It might not make sense ever for us to be partnered with you. I might think you're the best investor in Japan equities, to keep using this example, but CalTech might never have a desire for that single strategy. But I talk to plenty of other peers, and one of them might mention that they're looking in Japan. And if I had a really interesting, constructive conversation, I'm going to pass along that name, and I might be useful in that way. So I think those who get it recognize that it's a long game, and recognize that there's a lot more to developing a relationship with those of us on the allocator side than just whether or not we ultimately invest with them.
It does raise a question, though. I mean, you have a relatively concentrated group of asset managers. You are looking at emerging managers. I think all of us can appreciate the advantages of a longer courtship. But there's also something to be said, having gone through that whole courtship, whether you could establish a royalty with these asset managers by taking equity in their business, or potentially doing some type of revenue share or profit sharing arrangement. Will you take those relationships to that extent? Because, Andrew raised a good question on, just in terms of emerging managers, the definition of emerging managers. There's also no shortage now of emerging manager programs. So they're trying to differentiate themselves with each other. So as you think about your seat and what's happening in that space as it relates to that royalty, is that something that is that a path you would go down?
No, I mean, historically we haven't. We're obviously very curious about the viability of the business, and who are the the equity partners, if there are any, who are the outside interests, how are they aligned? Obviously, all important considerations in any stage fund, even $20 billion hedge funds. You want to know those things. But no, we historically don't go down the road of trying to take a stake or become an equity partner.
Oh, thanks. I appreciate that. Well, you mentioned crypto, and I'm in a university setting, so I can't help myself. I sit in the School of Entrepreneurship at Drexel University, so I'm either hearing about one of three things: ChatGPT, artificial intelligence, crypto, blockchain, or something. The creator economy. So those are my three. That's all. If we talk about like how small my world is,
I feel so bad for you, Rob.
No, I feel very. Doug, I feel very youthful, but I am okay. Not youthful. Right. But it does make me feel good, at least understanding like what's going on. But it's interesting, and as we were doing just a little research on you, Doug, I saw that you were asked a few years ago as part of this next CIO masterclass competition that was held by Institutional Investor whether crypto and digital assets should be part of an institutional platform. And I should also say, Doug won this competition. He was named the next CIO by Institutional Investor. So I was curious if you remember that answer and if it's changed.
I do. I remember my answer very well. And no, it has not changed. My answer was not in any portfolio in which I am involved. And the very straightforward answer is that I don't understand crypto. I honestly, I don't, if you will, I don't get it. I don't understand the use case, to take it sort of into a financial parlance, but taking even a step back, I don't really get what Bitcoin is. I don't really get what digital currency is. It's just not something I fully understand. And so, the most fundamental role that I have at CalTech is as a fiduciary, right? That is first and foremost always. And so, and I say this to younger members of the team, if you're ever in a elevator with the chair of our investment committee and you get asked about a strategy, if you can't explain it in 10 seconds, it's pretty likely that you shouldn't be invested in it. And the truth is that I just don't feel that I have the knowledge of what crypto is about or what Bitcoin's about. It just doesn't really add up to me. It doesn't make sense to me. And if that's the case, then that's an asset. If you even want to call it an asset, that's something I shouldn't be invested with, and that's fine, because the beauty is other investors, other peer institutions might get it, might have a view that they feel is informed, and that's what makes investing fun. Is you don't need to be in everything. But no, crypto is not something that I feel I understand. And if I don't understand it, then I shouldn't be invested in it.
Well, I don't know about you, Andrew, but I feel a lot better because I don't understand it either. I listen to it all the time. So I appreciate that answer. Sounds like the panel probably appreciated it as well.
Again, I'm still looking for a use case. Bitcoin's been around 15 years, and I'm still not sure what you can do with it other than convert it back into US dollars, which seems, anyway. No, I'm with you. I appreciate that, and thank you for following up with it. But you did mention that fiduciary responsibility, so governance is part of that. So it's as important as ever. It's obviously always been important, and this is going to take us into ESG. But when you think about governance in light of what's been going on, can you share with us your approach to governance within the endowment, how you think about it? Obviously, you said we write these checks, 10 million, 20 million, $100 million, but there are educators behind it, there are buildings behind it, there are grants behind it potentially. So any comments on governance and your thoughts on where we'll go with kind of the context of where we are today? I mean, there's obviously the governance that's established just in CalTech, which I think is probably fairly consistent across most of the endowments, in that there's typically an investment office, which is typically reports to an investment committee, which is often a subcommittee of the board of trustees. So there's several layers of oversight and governance that sort of sit on top of an investment program. What is different is sometimes the discretion that an investment program has. At CalTech, the investment office has a pretty broad investment discretion, where while we certainly inform our investment committee of every investment, only those that have a particular illiquidity or size actually require investment committee unanimous approval. So again, we're always informing them of any decision we make, and we welcome any sort of feedback. And when it comes to actual approvals, beyond just the seven of us on the investment team, only illiquidity or size can trigger requiring a unanimous approval of our investment committee. So I think in general, you obviously want broad governance to me, it's a help to keep you out of trouble. It's an additional set of eyes. It's a perspective that goes beyond the seven of you in the investment program. Yes, there's seven of you, and you all come with your different backgrounds and your different asset class priorities. But you can still become myopic as a group. And so it's important that you have those outside of you to whom you are responsible to whom you report quarterly. It's important even, sometimes I have peers who begrudge having investment committee meetings because they find it just so mundane, and here we go doing this again. And I actually think there's a real value to just walking through the mundane to an outside audience, because you just don't know what kind of questions it's going to prompt, different perspectives, different viewpoints. So that is hopefully a sense of the broader governance. In terms of how we think about governance of the funds that we invest in, it's we obviously have a full operations team. We do full operations due diligence. We do use we do outsource as well to a third-party provider for additional support on due diligence. That's the only outside provider we use in the office. We don't use one on the investment side, but we do use it on the back office side, just for, again, an additional set of eyes. Are we missing anything? That's the piece of this, right? It's the governance, the fiduciary part that you can't get wrong. you're going to get investments wrong, Rob, right? You know, you're going to get things wrong. You're going to buy gold, Bitcoin at 60,000. And that's going to happen, but you can't get the governance wrong.
Doug, you brought up an interesting point earlier about, is there a fit for the endowment? And I'm just curious, there's a lot of noise out there, but is there anything you're more open to in terms of asset classes and evaluating active managers right now in terms of what's coming across your desk versus other areas?
In all candor, the challenge at the moment is with public markets having been fairly flat to down for a decent amount of time now. Obviously, the illiquid asset classes, the private equity and the venture, those marks were lofty to begin with. There is not a whole lot of liquidity running around investment pools like ours right now. So I would say at the moment, a big focus of mine is on liquidity, is on making sure that, because we have that payout every 90 days, our reason for existing. And so the treadmill that we're on is that every 90 days we have to come up with X amount of dollars to fund the payout and to fund the school. And that check will go out 90 days later and 90 days later and 90 days later. And so in environments like this, where public markets aren't just reflating, where the private marks are probably topped off for probably a while, I would believe, liquidity becomes a bit more of a challenge. So I'm sorry, it's a very roundabout way to saying there isn't a whole lot on the radar today. I would say that fixed income has become interesting for the first time in my 9 years at CalTech. The challenge is that even though I can maybe get 5% on 2-year treasuries, is my payout is still above that. Like it's a lot better than getting nothing, but it's still not really meeting the objective of what we need to achieve. And so it's more interesting. I would say probably distressed credit is going to become a lot more interesting if things get more wild and wonky than they have begun to get. It's certainly in the regional banking side. And so I think that could become a more interesting area. And, on the equity side, I still think emerging markets have been pretty much left for dead for a while. And that's probably a more interesting space. It's sometimes, I can tell you, we're not looking in U.S. equities. We don't find that interesting today. We're in a re-up cycle on the private and venture side, but not really leaning into that space for obvious reasons from earlier conversations. It's a bit more of a liquidity and I'd say a little bit more of a preservation mode right now.
Well, Doug, thank you so much. We're at the top of the hour, so I want to be mindful of your time and Andrew's time as well. So thank you for being here today. Congratulations on all your success. I do have a quick congratulations as well to your husband and you, Ronnie Wu. For those in our audience, and I know it's a big one for Doug because Doug has been on the road with Ronnie, helping promote his new book. For those of you in the audience who don't know Ronnie, he's a professional chef and food personality. He released his first cookbook on March 14th. Did you eat yet? And there's a link on this book. There's a link to the book on our YouTube page. But how's it been since the?
That's really sweet.
Yeah, absolutely. How's it been since the release?
Yeah, thank you. That's really generous of you to bring that up. It's been a wild 3 years. He inked the deal with HarperCollins in the teeth of COVID. Right, having never met any of the editorial team or the publisher, and then we produced the entire book during COVID, and it's really exciting to see his 3 years of effort, culminate with the launch of the book. And being with him in New York a couple weeks ago and seeing him on GMA and Drew Barrymore promoting it, and it's been a lot of fun. So thank you for referencing it.
No, it's our pleasure. I actually did it mostly for Andrew. He only cooks wings apparently, so I wanted to make sure he was aware.
My husband loves wings, and there is a really good wings recipe in the book.
All right, I'm buying it.
Well, I also want to plug your sister because she's a graduate of Drexel's LeBeau School of Business with an MBA.
That's right.
I've become endeared to Drexel Drexel University, teaching there now in venture. So I also wanted to mention her. But Doug, thanks so much. If you want to learn more about Doug and CalTech's investment office, please visit their website at www.investments.caltech.edu. As I mentioned before, you can find a copy of Ronnie's book, Did You Eat Yet? On Amazon.com or at your favorite bookstore. You can find this episode and past episodes on Spotify, Apple, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. And finally, if you would like to catch up on past episodes, check out our website at Dakota.com. Doug, it was so nice. Thanks so much for being here today.
Yeah, guys, thanks for having me. I really enjoyed it.
It was great. Very insightful. Thanks, Doug.
We did as well. And we'll see you soon.
Don't say good.